100% tax write-offs, passive losses, and zero capital gains. These are just some of the reasons real estate investors pay far less tax than other high-income earners. Real estate has long been considered the ultimate tax shelter, and with the 2025 tax changes, it's becoming even more powerful. The permanent restoration of 100% bonus depreciation is just one of the many advantages that make real estate perhaps the most tax-efficient investment vehicle available today. In this video, we'll go through 5 major tax benefits that give real estate investors a massive advantage. I'll walk you through depreciation, bonus depreciation, cost segregation, 1031 exchanges, and the powerful real estate professional status. Whether you own 1 rental property or 20, or you want to get into investing in real estate, these strategies can help you legally reduce your tax burden. If you're serious about building wealth while minimizing taxes, hit the subscribe button. We're sharing financial strategies every week to help entrepreneurs and individuals save on taxes and build wealth. Here's the reality. When it comes to tax planning, W-2 employees can only deduct so much, while business owners and investors have far more opportunities to reduce their tax liability. Real estate stands out because the tax code actively encourages investment in housing and commercial property through numerous incentives. These aren't loopholes. They're intentional benefits designed to stimulate the economy and increase housing supply. Yet most real estate investors only capture a fraction of available tax benefits. They might know about basic depreciation, but they may miss out on more powerful strategies that can dramatically reduce their effective tax rate. Let's explore the 5 major tax advantages that make real estate investing such a powerful tool and how the 2025 changes make them even better. Let's start with depreciation, the foundation of real estate tax benefits. Even though properties typically appreciate in value over time, the IRS allows you to deduct the cost of buildings as they theoretically wear out. This depreciation deduction creates a paper loss that offsets your rental income, even when your property is actually cash flow positive. Residential properties are depreciated over 27.5 years, while commercial properties use a 39-year schedule. This means you can deduct approximately 4% of your building's value every year without spending an additional dime. For example, if you purchase a $500,000 property excluding land value, you'll get about $18,000 in annual depreciation deductions. If you're in the 32% tax bracket, that's a $5,760 tax reduction every year without additional investment. But standard depreciation is just the beginning. The real power comes when you accelerate these deductions. Let's talk bonus depreciation. We mentioned this in prior videos, but starting January 20th, 2025, the tax code permanently restores 100% bonus depreciation on qualifying property. This means you can deduct 100% of eligible property components in the first year rather than waiting decades. This represents a dramatic reversal from the previous phase-out schedule, which had reduced bonus depreciation to 80% in 2023, 60% in 2024, with a schedule to decrease at 40% in 2025. While the building structure itself doesn't qualify for bonus depreciation, many components within your property do, which leads to our next strategy, cost segregation. Doing a cost segregation study to unlock accelerated depreciation potential. Cost segregation is a tax strategy that identifies and reclassifies part of your real estate from long-lived assets to shorter recovery periods of 5, 7, or 15 years. Through an engineering analysis, you can legally segregate components like carpeting, decorative fixtures, and window treatments. Also, electrical systems specific to equipment, and land improvements like parking lots and landscaping. As a general rule, a cost segregation study can allow for 20 to 40% of a building's cost to be reclassified into shorter depreciation categories. This strategy can work for properties of all sizes. Even a $500,000 rental home can yield tax savings when properly analyzed. Let's get to the next opportunity, 1031 exchanges. This strategy can indefinitely defer taxes that you pay on gains when you sell property. Here's how it works. When you sell an appreciated property, you would normally pay capital gains on your profit. However, Section 1031 of the tax code allows you to defer those taxes if you reinvest the proceeds into a like-kind property. Now, there are a lot of hoops to jump through and a lot of requirements to qualify for a like-kind property, but it could be worth it to take a look. This powerful strategy lets you essentially trade up to larger properties without paying taxes on the gains from each sale. You can repeat this profit indefinitely, building a larger portfolio while deferring taxes potentially forever. Additional power from 1031 exchanges can come from combining them with stepped up basis when you die. If you hold your properties until you pass away, sad, I know. Your heirs receive their properties at the current market value, completely erasing any deferred tax liability. This combination of 1031 exchanges and stepped-up basis means it's theoretically possible to build massive real estate wealth while never paying capital gains on the appreciation. Now let's get to the holy grail of being a real estate investor from a tax perspective. Real estate professional status. While the previous strategies benefit all real estate investors, real estate professional status is the ultimate tax advantage for those who qualify. Normally, rental property losses are considered passive and can only offset passive income. But with real estate professional status, these losses can offset your active income, including W-2 wages and business profits. To qualify, you must do the following. Spend more than 750 hours per year in real estate activities, spend more than 50% of your total working time in real estate businesses, and materially participate in your rental activities. If you or your spouse meets these requirements, the tax savings can be extraordinary. When combined with cost segregation and bonus depreciation, real estate professional status can potentially reduce or even eliminate tax on all your other income sources. For example, a doctor earning $400,000 annually whose spouse qualifies as a real estate professional could use property losses to significantly reduce their family's overall tax burden. This is perfectly legal when properly documented and executed. So how do you implement these strategies for maximum impact? Here's your action plan. For new investors, start with standard depreciation and learn the basics of tracking income and expenses properly. As your portfolio grows, consider cost segregation studies for properties valued at $500,000 or more. Many cost seg firms offer free benefit analyses to show you potential savings before you commit. For any property or assets you bought in 2025, see if you qualify for bonus depreciation to take the benefit this year. For active investors, evaluate whether your spouse might qualify for real estate professional status and begin documenting your time accordingly. For all investors, work with a tax professional who specializes in real estate. Not all CPAs understand these advanced strategies, so find one with proven experience serving real estate investors. Remember, these strategies can work together. The real magic happens when you combine multiple approaches into a comprehensive tax plan tailored to your specific situation. So today, you'll learn why real estate can be one of the most tax-advantaged investments available and how 2025 tax changes make it even more attractive. So what's your homework? Review your current real estate strategy or lack thereof, and identify at least one area where you could be saving more. Schedule a consultation with a real estate tax specialist to discuss implementing these strategies. Before I go, I want to know which of these 5 strategies are you most interested in implementing in your real estate portfolio. Drop your answer in the comments below, and I'll personally respond with specific insight to your situation. And if this video helped you understand the tax benefits of real estate investing, hit that subscribe button so you don't miss out on our other videos covering tax and finance strategies. Talk to you soon.